Thanks everybody for coming out. How many marketers do we have? Marketing folks. It's pretty about half. It's a pretty good turnout. A lot of the big name companies out there today making headlines: Facebook, Google, Amazon, all marketing companies. It's a really good time to be a marketer. And there's lots of cool tools out there, lots of cool marketing tech tools out there that make it a lot more fun these days. When I talk about marketing science, I'm usually talking about the intersection of these three areas, this idea of the rigor and discipline of statistical analysis and data science, where that overlaps with this lens of consumer behavior for interpretation, and then applying it to business strategy, the context of business strategy to actually impact the value of a firm. There's lots of interesting stuff going on where those three intersect. When I talk about customer centricity, though, it's a little bit fuzzier. It's a term that a lot of people use differently to mean different things, so I thought let's clarify what we mean for this presentation. It's become a bit of a buzzword. It's synonymous with great user experience, great customer service, all these things. And I'd argue that these are actually levers within a higher order strategy of customer centricity rather than synonymous with customer centricity themselves. Customer centricity is really a disruption to the way that marketing's been done for a really long time. It's a way that we can start thinking about customers as assets, which helps us as marketers start thinking about marketing as an investment rather than an expense. There's a professor at the Wharton School, Pete Fader. He wrote this book, Customer Centricity. Really good book, aligns with a lot of what we'll be talking about today. His definition of customer centricity is that customer centricity is a strategy that aligns a company's development and delivery of its products and services with the current and future needs of a select set of customers in order to maximize their long-term financial value to the firm. And key word in here is select set of customers. It's not about delivering that outstanding service necessarily to everybody. It's about understanding who your most valuable customers are and then tailoring your company to super serve those customers in order to have strategic advantage. And key to that is understanding first who your most valuable customers are. It also takes a long-term view rather than short-term, which is often a challenge for marketers to be arguing with in the business, the long-term versus the short-term priorities. So if this is disruptive, what's it disrupting? The old style is more product-centric. This is how most companies are organized right now. Product at the center. You go out and find customers for that product. You measure it by a P&L for a product. You add up the P&Ls, and that's your value of your firm. Customer centricity is the inverse. It's putting the customer at the center. It's calling the customer the central economic unit. And it's measured in customer lifetime value. And just like you'd add up all the P&Ls to get a firm value there, you can add up all the customer lifetime values of all your customer, and that's the firm value as well. These circles around it in the periphery here are what products and services that they spend. These are really interactions. So if you think about product centricity as transactional and customer centricity as relational or interactional almost. So interactions. These interactions could be social media shares. These could be recommendations to others. These could be customer care calls. They could, potentially things that are cost drivers rather than just revenue drivers. All aggregated together give you a full view of your customer and can be used to determine customer lifetime value. It acknowledges that the value is in the relationship here. The value is really in the relationship here and not just in product assets. Now there are a lot of companies, most companies are out there product-centric right now. And there are a lot of really successful companies that do this really well. However, I think as the markets continue to evolve, folks that are in this product-centric bucket are going to continually be challenged. And I'll show you why in a few slides. So there's two main pillars of customer centricity. In order to be customer-centric, first you need to recognize that certain customers are worth more to your business than others. Some are more valuable than others. There's no average customer. They're all different. There's heterogeneity across the base. And secondly, you need to use that information to inform your investment priorities as a marketer. Your level of service, your costs of acquisition, everything that goes into servicing that customer over their lifetime with you. And that's how you maximize your overall firm value. And that's how you turn marketing into an investment rather than an expense. So to do number one here, you need to have a method of actually calculating customer lifetime value. You need to be able to understand what the value of a customer is. And there's old school textbook ways to calculate this, and they have their own set of challenges in terms of the type of business and how their accuracy. In recent years, you got a lot coming out of academia for predictive models for this that are really impressive. They do a really good job. In order to do the second one, you need to have an operational model that allows you to be flexible based on the value of a customer. So why now? Why this disruption is happening now? Why not 20 years ago? And there's a number of reasons for this. Value is moving downstream. Value used to be in these big companies that owned huge assets in manufacturing companies, development, in logistics, in legal and accounting services. These things have become more of a commodity. They've been easier to outsource, easier to access through different means. They haven't necessarily been the pillar of establishing strategic advantage that they once were. And the value is moving downstream to the customer relationship. The company that understands and controls that customer relationship is where has the best chance of evolving with the customer as their needs change, as they continue to evolve. Second reason, omni-channel interactions are now the norm. So I go to lunch and I may look on my phone and research flat screen televisions. And I come back up after lunch and I go to my desk and I order one. I go pick it up at the store, in-store, take it home, and if I have a problem with it, I call this 800 number. And if they haven't resolved my problem to my satisfaction, they might hear about it on social media. That's 5 different interactions for the same transaction over 5 different channels. And in a product-centric model, you'd have no way to tie all those together. So you'd have no way to tie those interactions together and find out what's the net value that I've either created or destroyed based on the interaction there in that customer. But in a customer-centric model, you tie all that to the customer, and you can capture a lot more of the value of the various interactions. Another thing is consumers are more empowered than they've ever been. Smartphones in your pocket, you got the internet in your pocket, all with conveniently placed buy buttons next to everything. If you're not creating more value for a customer than just the product on your shelf, you stand to be commoditized. The value is in the relationship, and the switching costs are lower than ever. And a fourth reason, it's actually possible now. So just in the last couple decades, the advancements that have been made in cloud computing, cloud processing, the advancements in predictive models and analytics, the abundance of thousands of marketing tools tech tools that are out there that now enable you to do the type of analytics that wasn't necessarily possible a couple of years or wasn't cost effective a couple of years ago or a couple decades ago, has been a big change. I mentioned customer lifetime value. This is the customer metric. This is the key metric of customer centricity. And ultimately, this is future revenue from a customer minus the future cost of servicing that customer. So everything you're going to get from a customer in the future, from all their transactions, minus whatever cost, the cost of goods, the cost of service, cost of care, bad reviews, they have potential cost. All discounted back to today for time value of money, because $1 today is worth more than $1 tomorrow. And there's a special flavor of customer lifetime value called residual customer lifetime value. That's your forward looking. That's from today forward. And when you make marketing decisions, this is what you're most concerned about, the value of a customer today. Past revenue, past cost, those are sunk. If you're making investment decisions, you want to make a decision based on what that customer is worth to you today going forward. And I mentioned prediction is a way that I really like to dig into this. A lot of prediction algorithms, but they do have their challenges as well. They're based on probabilities. There's inherent uncertainty when you're dealing with probabilities. Latent attrition, so this idea that not all businesses know that I'm not a customer anymore. When I end my customer lifetime with them, the coffee shop down the street, downstairs, I don't have to tell them that I'm not a customer anymore. Like a utility, I might. So they have to infer that based on my behaviors. Data volume, so in both directions. Too much data coming at you from all directions, being able to make sense of it and organize it in a way that can be useful, as well as too little data. If I'm an auto dealership and my repeat customers have years between their visits, and I only have a couple years of data, I'm going to be challenged to figure out an accurate model for predicting their customer lifetime value. A visual here that maybe helps illustrate the customer lifetime value a bit. 3 customers, This left side, this is today. 3 different lifetimes. So the blue lines are their lifetimes, forward-looking from today. We've got prediction algorithms that say when we're going to have transaction events, what their frequency is, their average frequency and a certain randomness around that, their average transaction values and a certain randomness about that. There's going to be positive, there's going to be negative ones. We're also forecasting their lifetime, and this is based on their previous behavior as well as the behavior of others that joined, that became customers at about the same time, so other people in the same part of their life cycle. Now if you take all this, you take all the green lines, you take all the red lines, again, $1 today worth more than $1 tomorrow, so discount each of these back, roll them back, sum it up with the other 100,000 people in this group, and you'll end up with a point on this graph. This is a customer lifetime value graph. In this case, this is real data. This is a cohort of customers for a coffee shop. Everybody who joined or first became a customer in this case, April 2015, joined. And as they're joining, the value of this cohort's going up until it caps off, until it stops, because May 1st hits. And on May 1st, new customers are now part of the May cohort. So just by definition, there's no more customers that will join this cohort. And what you see is a gradual fall off over time. And that's because 2 things are happening. One, you've got some attrition. You've got some people that are quitting your business. You've also got future transactions you predicted that are happening. They're captured. Person actually came in, made that transaction. That goes into the past. That goes in their history. So it comes out of the forward-looking piece. Now these graphs are really helpful for measuring the actual impact of marketing activities. So let's say instead of this being a cohort of people that joined in April 2015, this was everybody in a loyalty program and a campaign I ran. And I spend $1,000 to run this campaign. This is notoriously difficult to figure out what the value of a loyalty program is. Is it worth the money we're spending on it? Am I getting anything back? Did I just give discounts to people who were going to spend full price anyway? Anyone who runs a loyalty program probably has to make that case to their boss all the time. Or how do I tell that story? Well, if I know today that my prediction, and I have confidence in this prediction, is that this cohort, these people that I'm targeting are worth $54,000 going forward, and in a month they're going to be worth $50,000. And I go spend $1,000 on them, and I get to the end of that month and it's 52. So I expected 50,000 and it's 52. I spent 1,000, I returned 1,000. I've got 100% return on my investment. I can show that I've actually built customer equity in those campaigns. So let's talk about customer centricity in a perfect world. And this is not the world we live in, but let's take a perfect world view here. In a perfect world, we'd have a single version of the truth. We'd have one official record, system of record. It'd be very organized. We'd know every interaction that you had. We'd know when you came in the store and bought something, when you came in the store and didn't buy something, when you visited our site, when you opened our app, when you drove by, when you went to our competitor's store and bought something. We'd know every identifier about you. We'd know your loyalty card, your credit card, your email, your mobile, anything that can help, your cookies, your IP address, whatever it is, anything that can help tie a transaction back to you as an individual with 100% certainty that it's actually you. And while we're asking for the world, why not get it all in real time? This is your ideal world scenario as a marketer, but it's not anywhere near the truth, right? Data is unstructured, it comes fast and furious. Figuring out where the pieces that are worth something to you is a challenge. It's inconsistent. Even though we see so much more of a customer's digital life than we used to, it's still just a really small sliver, and there'll always be pieces of it that are intangible or unobservable that will never end up in a CRM system for us to base any model on. More data, more privacy concerns, more security concerns, all need to be weighed in. And we're often not 100% certain of the attribution. So, my wife and I have the same credit card number. I can't tie that back to one of us. Or she takes my keys and my loyalty card number's on there. Or we share a computer. There's a number of things. Or I'm on Amazon and I buy something, but I buy it as a gift for someone else. So it might be valuable that I bought it at Amazon. They might like to know that, but the content of that purchase might not be relevant for them putting a profile together about me. So let's take a tale of 2 retailers here. Nordstrom is known for over-the-top customer service, famous story about returning the tires. And Walmart promises everyday low prices. Which of these companies is customer-centric? So it's a trick question. You want to say Nordstrom because that's where they have the outstanding customer service. But the truth is, in terms of the product, the customer centricity as we've defined it here, neither of them is customer centric. Nordstrom isn't customer centric because that's the red carpet they roll out for everybody, not to their VIPs. In fact, every time they roll out the red carpet for someone that would not return the value in return, they've got a negative margin event, and it sacrifices what they could be spending on other folks that would otherwise return that. Now, I mentioned before, there are a lot of really successful product-centric companies, and these are two great examples. Their product is their retail experience, right? The great shopping experience and everyday low prices. That's their product. But I also said that product-centric companies would increasingly be challenged. Nordstrom, just a few months ago, talked about plunging sales, confirm a troubling new trend among wealthy shoppers. Shoppers are trading off less on luxury fashion goods and more on luxury cars and houses. There's a transformation. They're substituting goods, and having a closer customer relationship might have given Nordstrom a better view that this was going to happen and allowed them to prepare or adapt their strategy. Walmart has a very different challenge. So Walmart has had a really tough time in e-commerce. They've been doing it for a long time. They've had several restarts and relaunches of their site. They're having a really tough time competing against the likes of Amazon. Their in-store model and their in-store operations and everything that delivers that experience haven't translated well to the online world. So much so that just last month, in what's the largest acquisition of an e-commerce company ever, for $3.4 billion, they bought a company called Jet.com. Now, Jet.com sells everything from household goods to groceries, electronics, and furniture, aims to be cheaper than its competitors. This is all great. This is all very aligned with what Walmart's brand is. Gives customers a bigger discount the more items that are added to an order. Invests more in customers that are showing that they're going to spend more with the company. This is a flavor of customer centricity that has not to date been part of Walmart's strategy. Really interesting thing about this, Walmart has been doing e-commerce for close to 20 years, competing with Amazon. They've only got a sliver of the market comparatively. Jet's only a year old. $3.3 billion. All right, second part of this. That was the overview of customer centricity, but I want to take you through a simulation, some real data, and show you what customer centricity might look like in a real world scenario. This is real data from a coffee shop. This is 476 individuals. Each circle is one person. They're all from the same cohort. They all became customers about the same time. So all these circles, all these people are in the same part of their life cycle with this coffee shop here. They're all sorted. We ran 6 months of data and did a prediction on their residual customer lifetime value. So that's what this scale is. This is their residual customer lifetime value. And they're ordered by this. So these folks up here, approaching $2,000 in value as customers. You know, we got about 1,000 line here, group over here, 500, and a long tail down here. And these folks, not so valuable. They may be not infrequent buyers. They may not be they may be one-timers. They may be someone that comes in, let's say this was a department store. That might be someone who buys something one week and returns it the next, buys something one week, returns it the next. Or maybe they incur a lot of customer care costs, more than was factored into the initial pricing or the offer. But these are the low-value customers and these are the high-value customers. And you'll see this curve in any business. You'll see this curve. This is, if you're looking at marketing as customers as assets and managing a portfolio and getting the recognition from the organization that you treat customers as assets and they should treat marketing as an investment, this is your portfolio that you're managing. Your goal is to get more of these circles and fewer of these. And that's going to be different for whatever business you're in terms of what that actually looks like. I mean, these aren't necessary. This could be a piano store, and these are just guitar players. This has had nothing to say about what those customers are. This is just the reflection of their behavior in their purchasing patterns and in the data. And if I'm a piano store, I want more piano players. I want less guitar players. So you probably have an intuition in your business about what is a signal that someone is about to drop off or unsubscribe or stop being a customer of yours. They used to come every day. They've come infrequently. They've got a recurring membership, and they haven't been in a while. They haven't used it in a while. These are signs you might intuitively know about your business that says someone might be at risk of leaving my business, stop being a customer, ending their customer lifetime with me. Once you get into the data world, you store all these signals. You can run the machines at it and let it figure out who's most likely to leave your business. So that's what I did here. I ran the data, and I asked who were the most likely to churn as customers of this coffee shop. 56 triangles right there in red. 56 people that are most likely to leave this coffee shop. Have you heard the old adage that costs 10 times more to acquire a new customer than it does to retain one? 7 times, 5 times, some variation of that. Lots of numbers out there. The question you should ask is which customers? So let's take a hypothetical. Let's say it costs $100 to retain a customer. This is the $100 line, this dotted line down here. Should I spend $100 to retain any of these folks? Right, that'd be a negative transaction. And in the most extreme case that I've heard, so 10 times, let's say, it costs $1,000 to acquire a customer. Well, I told you these guys are worth $2,000. So I should be willing to spend $1,000 a day, all day, if I can buy more of these customers and save by not spending on these customers. This is how I'm adjusting my portfolio. This is how I'm treating customers as an asset. Let's look at this a little differently. Have you heard of the 80-20 rule? The idea that 80% of my sales come from 20% of my customers. In different businesses, it'll be a little bit different. But this is a Pareto curve, and all I've done is taken the same customers and ordered them a little differently. This is the percentage. This is a cumulative percentage of the value in that cohort, and this is the percentage of customers that it represents. And so if I draw a line at 20%, I can see where they intersect, that my top 20% of my customers represent about 55% of the value in that cohort. So top 20% represent 55% of the values. And if I place those people at risk back on the line, this should be concerning that more than half of my value is on this side of the line, and I've got a lot of red there. All right, back to the last view. Let's say I have a $2,000 retention budget. I know from past history that I can spend $100 per person at risk, and I'll confidently get 50% retention. Every time I run this campaign, this is my go-to campaign, I get 50%. I'm not going to be able to save everybody. Some people have legitimate reasons for not being a customer anywhere, but I know I can confidently get 50%. If I have my way, I want to run this campaign. This is my all-star. But I only have $2,000, so I can't do that. Let's start with a non-customer-centric view. If I am non-customer-centric, I don't know what any of these people are worth. I don't have this order here. So what I might do is say, I know 56 people at risk, divided among the $2,000 among them. I'm going to only have $36 per customer. I'm going to run this campaign. I'm not going to get my 50%, but let's say I'm going to spend about a little less, about a third of what I would like to spend. Let's say our retention rate still is a little bit more than a third what we'd have in our ideal case. We run the simulation. We retained 11 customers across the board. $2,161. If I add up all those green dots and say what they were worth. So if those people had all left, I would have lost $2,161. I spent $2,000, and now I'm positive by 8%. Like, that's not awful, right? This doesn't always happen this way. I got more back than I would have spent otherwise. But let's take a look at a customer-centric view of the same challenge. So instead, we're going to take our 2,000 retention budget, and I say, I really want my campaign. This is the one I know is going to do the best for me. I want to spend $100 per person and get my 50%. I can't do it for everybody, so let me start with my top 20 triangles, my most valuable triangles here. Not 20%, just the top 20 people that are at risk. I've run the simulation. I got 10 customers. Last time I got 11. Did I mess it up? Why is this different? Yeah, so I didn't get 10 across the entire base. I got 10 from my top 20. And if I add those up, if those people were going to leave, I now saved $5,676. So I spent $2,000. I got 184% of return on investment. And so this is the kind of thing that talks about customers as an investment, and that marketing was an investment, not an expense, because I can tell you what the value I brought back from it was. So we made a lot of assumptions here, right? We assumed our star campaign is going to do what it always does. But let's say we cut it in half. Let's say our take rate is half of what we usually get. We usually get 50%. I can count on it. For some reason this cohort's different, and I only get half that. I saved 5 people. Run the simulation. The value of those green squares is $2,338. So my ROI is 17% return on investment here, which is more than double the 8% I got in the non-customer centric. So even with half the performance of what my star campaign here. Just to summarize the example here, so we had $2,000, we had 56 people at risk. We tried a non-customer centric approach, which gave us about $36 per target customer. We targeted everyone at risk and we got 8% return. Then we took a customer centric view. We ran our all-star campaign against just the top 20 people. We said ignore the other 36. We don't have budget for them. And we got 184% return. And even when we cut that in half and we said, what if we only get half the take rate we normally would expect, we still did double as good as we would have in a non-customer centric approach. So if you start thinking in terms of customer centricity, a couple more things become possible. Think about the idea of commissioning salespeople based on the customer lifetime value that they bring in rather than the initial deal size. Think about how that might change incentives. Think about cost per acquisition, setting a ceiling on cost per acquisition. I was talking to an investor, a local investor here who invests in a lot of startups recently, and he said this is a problem for all of his companies that he invests in. They all know how much they're spending on acquisition, but they can't tell you whether that's too much or whether they should be spending more or too little. They don't know what that relative context is. They don't have a good way of telling you what the lifetime value is. But that should be my ceiling on what I'm willing to expend. If I go figure out what the customer lifetime value of everybody that comes through Facebook ads is, that should tell me where my ceiling is on that. I could even build in, the margin I expect in order to make that calculation. It can help you find more of your best customers. So those people that were $2,000 up here, start looking at what's different about them, what's unique about them, what do they have in common. Maybe they all came through the same channel. Maybe that tells me to invest more. Similarly, what if all these folks down here came through the same channel too? I might say I really don't want to invest in channel B. I want to take money from channel B and invest more in channel A here because that's giving me more of the portfolio mix that I'm looking for. As we saw in that green graph, you can use customer lifetime value to measure the impact of marketing campaigns in an actual return on investment way. So, a lot of the best way we have now. So I sent out a newsletter and had a coupon in it, and next week I figured out how many coupons were redeemed, and that's my percentage. That's how successful the campaign was. It was 10% this time. It was 8% last week. I did a little better than last week, and that might give me a relative view of whether this one did better than that one. But it really doesn't tell me anything about the value that I drove for that company or through that campaign. It doesn't tell me whether I gave discounts to people who otherwise would have come in anyway and spent full price. It doesn't tell me if I extended someone's lifetime with me. And when you have stats like that, that's where marketing starts to get thought of as more of an expense. We ran this campaign. We know overall we get some response and it seems to be positive, but we can't quantify it until we start thinking about customer lifetime value. I have a client that does call centers, and they had a concept of saying, what if we look up the caller ID before we even answer the phone, before we even route the call? Someone calls into their customer care center, and if we're showing that they're one of our $2,000 customers, and we also have a flag on them that they're likely to churn, let's bump them to premier support, front of the line, and make sure we get someone on the phone that's really good at retaining customers before the call's even answered. And exactly what we did in the simulation, we can save money by not investing in the folks that are not the guitar players rather than the piano players in order to spend more on the piano players and increase our overall customer equity. So if this interests you, if this got you thinking about customer centricity, if you're responsible for customer centricity or marketing at your company, check out this link. If you're interested, it's a quiz. Figure out how customer centric you are. Customercentric.marketing. And what I'll do is after I get enough responses, I will send you your score, and I'll also send you an average of everyone that participates so you can have some context for where you stand in terms of the room there. But yeah, quiz on how customer-centric you are up at customercentric.marketing. That's what I got. Hope you learned something interesting today. Any questions? Yes.
So for the response rate hypothesis, you had 20% for the non-targeted, 50 and 25%. How do you go about getting to a realistic hypothesis for those different segments based on what your assumptions about the lifetime value?
Yeah, so past history. So the reason I knew that if I spend $100, my all-star campaign returns 50 is because I've run it before, and I know that every time I've tried something, I've either come up shorter or I've spent more, but that seems to be the right mix. And that's as a marketing department, just tracking your past history of performance. Does that answer your question?
Sort of. So
Okay.
with the lifetime value analysis, you had 50% response rate among that group when you just were targeting them. So I guess my question is are you seeing in a customer-centric model a higher response rate among your more valuable customers?
Okay.
Is it more targeted, or
Right.
how are you coming up with the differentiation response
So the
rates?
question was, am I getting the 50% response rate on my targeted customers, my high-value customers, because they're high-value customers, they're different from my other customers, or is something else going on there? So what I did was, the 50% was based on just if I had run that campaign to anyone before. That was my hypothesis. That was my past track record, is 50%. What I did was I said, I don't have $100 to spend on everybody. My budget won't allow for that. So in the non-customer centric, I said, I don't know what the value of different customers is. I'm non-customer centric. I don't have a customer lifetime value. They all look the same. The folks that are down here versus the ones that are high value, they all look the same. So I'm gonna dilute my campaign. Instead of spending $100, I'm going to spend $36. And so then the assumption in the simulation was I wouldn't get my 50% if I'm spending a third of what I would normally spend for my all-star campaign.
Okay, thanks.
As a follow-up to that, have you found historically that when you are focusing on just those customers that are higher value, that you actually get a higher return because of the fact that they're more engaged in your services or anything of that nature? Or has it, like, if you know 50% is what the average is across the board, is the spectrum higher or lower with the higher value customers?
The question is, if you engage more with those high-value customers, do you notice that you get more engagement or higher value by focusing on them?
Go to 60% or 70%?
So what you tend to see, and I think each business is going to be different based on how you structure, what you tend to see is changing a behavior is actually really difficult. It's easier to find more people like the people that are already behaving like your high-value customers. And that's not to say you don't need these folks. Like the rest of this group here, especially all those people through that kind of long tail here, like they keep the lights on, they fund all the expenses. It's just where your margin is, where your profit is. It's coming from a much smaller portion of those customers, and it's important to understand where those are in order to fulfill, either maximize your firm value, if you're mission oriented, to have the resources to be able to have as much impact as you possibly can. That's coming from the folks over here, while these guys are sustaining the business.
What about just to talk about the low-end customers a little bit more, because they still are customers. Yeah. Is there anything that you have in place to convert them, so to speak, to develop a patent for them to potentially become a high-end customer? Yeah. Is there anything that you have in place for that?
So the question is regarding to the low-value customers, do we put anything in place to migrate them, try to help move them up the chain to more valuable customers? Similar to the last question, in that it tends to be more difficult to change behavior than it does to find more like that. And that's not saying these customers are of any lower value class by any means. If this is a coffee shop and they sell coffee, these might just be tea drinkers. Like they just might, if I'm a piano shop, these might just be guitar players. Like they're just not aligned with the value that this particular retailer does. It's not a matter of the specific person. It's all about driven by the behavior. Does that answer your question?
Is it easier for somebody like Walmart to adopt customer centricity, or is it easier for them just to pay $3 billion and hire a company that doesn't?
They think it's easier to acquire, for sure. And maybe that's not a lot of money for them.
Why is it so much harder to change what they've done in the past than you have had this?
I think so the question is, why is it so difficult for someone like Walmart to change what they've done in the past in order to add in customer centricity, and them clearly thinking it's easier to spend $3.3 billion rather than transform their organization. I'm sure that decision came after a lot of pain of 17 plus years of competing with Amazon and seeing where they are in many restarts. But ultimately, their entire promise of everyday low prices, anything that gets in the way of that, any overhead, they don't have a loyalty program. They don't do coupons. I made the mistake one time of actually pitching them on a mobile coupon. It was really bad. They don't do that. Anything they do, anything that introduces overhead or management of the relationship is overhead that means it gets in the way of the mission of everyday low prices. And so to transform that business, which actually works really well for them in retail stores, is just a monumental task and ultimately something different when it comes to online. So it's really tough.
I suspect part of the answer is organization. I saw when you drew the chart with the customer at the center and the services and products around it, I've kind of wondered why organizations aren't organizing that way. So when you see the hierarchical organization that Walmart still has, how can they possibly be customer-centric? And have you seen anybody doing any research and work in that area about how organizations need to evolve to support that new model?
Yeah. So the question is about organizational models. What's the organizational model that helps support customer centricity as opposed to product centricity? Because companies tend to be organized by product and product line, P&Ls. That's the way the finance guys like it. They're not necessarily mutually exclusive. You can have the marketing folks start looking at things from a customer-centric perspective. I think you see organizations where you see lifecycle management becoming a more important role. You see chief customer officers that are responsible for thinking about customer equity and customers as an asset. So you do see some things evolving. Different companies are going to figure out different things, and I think most companies are. It's not a transformation from one day we're product-centric to now we're customer-centric. We're product-centric, and now we're going to take this piece of it and we're going to be more customer-centric. Now we're going to take this piece of it and be a little more customer-centric, and ultimately we're going to try to evolve the way we think as a business.
Right. The question is kind of coming from visualizing how Walmart and Jet are actually going to integrate.
Yeah,
You know.
that's a big question. Yeah, absolutely. Thinking about how Walmart and Jet are going to integrate.
It seems like from what you're saying, the competitive advantage really comes from having some data that you can base your decisions off of. What would you say it seems like step one is to get the data. That's the first hurdle. Step two is to figure out how to deal with the data. If you were to give advice to a new business that has zero data, and they were to ask you what would be the most fruitful place to start collecting data, what would you say?
So the question is, if you're starting out new, you don't have any data, how do you start collecting that data in order to be able to start implementing this in the first place? In some sense, you might be in an advantage because rather than having to uproot an existing system that doesn't actually capture that, you can start by thinking about it from the beginning. And so thinking about what that single source of the truth, that single version of the truth is going to be, what system you're going to use, how you're going to access it, what types of data points you want to capture that you're going to use later. Just really mapping it out ahead of time. It takes, it's extra time and effort up front, but it saves you from having to course correct later on.
Are there any areas of focus that you would advise a business to take, like starting out?
Number one, transaction value. So the entire model that you saw for the residual customer lifetime value, the entire piece of that is based on transaction value. So if you can only get the top line, what the retail is, you can put some assumptions in there for margin in order to figure out what the real value, back down to the value. But if you're a restaurant, you make more on selling the drinks and the desserts than you do the actual meal, right? So a weighted average might not be the right thing to think about in terms of margin. You ultimately want that margin. Figure out what the transaction is worth to you. So that entire residual lifetime value chart was based on a unique identifier for the customer, the date of the transaction, and the amount of that transaction. And then that was all we needed to forecast the entire transaction lifetime. And then to figure out what those customers were or what was unique about them, we can start to say, all right, let me go find those people that scored really high there. Let me see those people that got really high numbers. What's different about them? What's unique about them?
Who does this really well?
Who does this really well? So I think aligned with the last question, one of the earlier questions too, is pieces of it are done really well by different companies. You know, Amazon knows your history, and they can target you with specific items that are most relevant and really push and understand what's going to cause you to trigger. And they do manage a version of this customer lifetime value for every customer in-house. They look at things like alignment to who's a Prime subscriber and what the difference that makes. And when they're looking at what's the difference between these $2,000 people and the people I get every day, they're looking at flags like that for sure. I thought a great example of customer centricity, this is going back a little while now, but Progressive Insurance, when they first came out, if you remember their initial pitch, and, car insurance, auto insurance, it's highly commoditized. What do? You call a bunch of companies, you get a price, and then you go with the one that's the lowest price. They're not really that different, right? They realize this is a pain point, and their initial entrant to market was to say, call us, we'll give you our price and the price of up to 3 of our competitors, sometimes with the highest, sometimes with the lowest. Just call us. We're going to solve that pain point of calling all these other companies. You call them up, you give them all the data they need in order to figure out whether you're likely to be one of these people or one of these people. And conveniently, if you're going to be one of these people, our friends down the street have a better rate for you. They get to cherry pick. They got people to call them up by solving a pain point, and they get to cherry pick more of the folks up here. And that's how they're managing their portfolio. And that's really customer centric right there. Any other questions?
Is there any type of offering that has been proven to be more successful with high value customers? Like, do they prefer better service, perks, discounts?
Yeah, so the question is, what type of offers tend to be resonate better with the high value customers? That's going to completely depend on your business, and that's where this doesn't automate the job of marketing for sure, but it's a lens to look through, right? So if you know where to look and you start to examine what's different, what's the behavior, what are the things, what gives me that 50% return versus a 30% return? Is it a type of offer? Is it a type of person? Is it a type of behavior that I'm observing? And really trying to interpret those results into actionable insights is still the realm of the marketer. This just supercharges you. This just gives you a lot more information to go on. Cool. All right, well, I'll hang out if anyone else has any questions, but thanks very much for coming today.